The market open is where everything happens. Volume spikes, volatility comes alive, and direction for the day often reveals itself within minutes. For traders who understand how to read that first burst of energy, the open is not chaos, it's structure. That's exactly what the opening range breakout is built around. The concept sounds simple. Identify the range formed during the first few minutes of trading and trade the breakout once price moves decisively beyond it. But simplicity doesn't mean randomness. There is logic underneath every ORB that works. And once you understand it, you can start to see the open for what it really is. A battleground between overnight positioning and new institutional orders. When the futures market opens, everything that happened overnight collides with everything being repriced in real time. Orders from funds, hedges, rebalances, all hit the tape at once. The opening range captures that battle. It defines who is in control and how aggressive they are. Once one side starts dominating, buyers pushing through the high or sellers cracking through the low, the breakout often carries genuine momentum. In futures trading, this concept becomes even more powerful. Futures markets are time-specific. They open at the same time every day, and that open has meaning. Stocks might have multiple catalysts, crypto trades around the clock, but futures, they reset with precision. That 9:30 a.m. bell for the indices creates a moment where liquidity floods in and emotion meets positioning. That's the perfect environment for structured breakout behavior. There is also transparency in volume and order flow that few other markets can match. Watching the footprint, the cumulative volume delta, these tools reveal whether the breakout is backed by real participants, by real participation, or if it's just noise. When a breakout occurs with heavy buy delta and strong volume, it's rarely retail driving it. It's institutional activity, and that's the kind of move that sustains. Now, to trade the ORB effectively, structure matters. The strategy is built around defining the first balance of the session, typically the first 15 minutes on something like Nasdaq. That first candle becomes your reference point. The high and low of that period form the range. Draw that box. It's your map for the rest of the morning. Once that first 15-minute range is established, the goal isn't to predict which way it breaks. The goal is to wait. Wait for confirmation. Wait for commitment. Price needs to break through that range and hold beyond it. Not a wick, not one tick poke, a genuine break with participation behind it. You can see it in the volume, in the time and sells. When price expands out of that range with energy, that's where the opportunity begins. Entries are straightforward when the logic is clear. A close above the range high signals strength. A close below the range low signals weakness. The stop is defined by the opposite side of the range. That's the beauty of the setup. Risk is naturally contained. If the opening range is 10 points on the S&P futures and you are taking the breakout above, your stop sits just below the low. It's mechanical, unemotional, and it aligns perfectly with that professional trader's value, clarity. Profit targets evolve with volatility. The first logical area to consider taking profits is equal to the size of the opening range. If the box was 15 points, the first 15 points of continuation often offer a clear exit. After that, structure can guide the rest. Higher lows, VWAP holds, volume clusters. Futures often trend cleanly for the first 2 to 3 hours of the day once that breakout sticks. So managing partials while trailing risk can turn an average morning into an exceptional one. The ORB works best when the environment supports momentum. Context is everything. Some days the market is balanced, waiting for news, digesting the previous move. Those days often trap traders who try to force ORB in conditions that don't favor expansion. When the pre-market is coiling tightly, when volume is light, or when a major economic event is scheduled within the next 30 minutes, those are signs to stay patient. The opening range might form, but there is no fuel behind the break. It's just noise waiting to revert. The best ORB days usually start showing their hand before the open. You will see it in the overnight session. Directional movement, consistent volume, and obvious bias forming. When price opens outside of the previous day's value area, when pre-market structure leans one way, when traders are clearly responding to overnight developments, that's when an ORB has real potential. Those opens tend to produce sustained directional drives, and that's exactly what you want to capture. There is also the relationship between the opening range and VWAP. When the range forms above VWAP, it often reflects initiative buying, meaning traders are actively pushing price higher instead of just rotating around value. When it forms below VWAP, the pressure comes from sellers initiating fresh shorts. Paying attention to that alignment can add a layer of confirmation to the breakout. The best breakouts tend to align with initiative activity and strong delta direction. Many traders get caught in false ORBs because they ignore the quality of the range itself. Not all opening ranges are created equal. A 3-point ES range during a quiet session is not worth trading. There is no room for structure to breathe. On the other hand, a 20 points opening range after a volatile overnight session can offer clear, meaningful levels that institutions care about. The more defined that early battle is, the cleaner the breakout tends to be. It's also critical to resist the temptation to anticipate. The ORB is a reaction-based strategy. The edge comes from waiting for confirmation, not from guessing. The breakout candle is your information. The volume behind it tells you whether it's real. Jumping in early may feel proactive, but it usually means you're entering inside the noise before the real decision is made. That's whether traders lose their confidence, not because the strategy is flawed, but because their execution is premature. When a clean breakout happens, it's remarkable how organized the market can look. Volume expands and price moves in steps rather than chaos. That's the kind of move professional traders live for. Predictable enough to plan around, powerful enough to reward discipline. Those trades often complete their initial move within the first hour. Beyond that, your focus shifts from entries to management, scaling out, adjusting stops, protecting gains. Risk management within the ORB framework is as simple as it gets. The structure defines the risk for you. If the opening range is wide, your position size should shrink. If it's tight, you can size up slightly. The important part is consistency. Using a fixed percentage of your capital or a consistent dollar risk per trade ensures you can take the next ORB setup without emotional hesitation. One loss does not define your day because your system already accounted for it. There is also a psychological advantage to the ORB. It gives traders a clear schedule. You know when you'll be active, when the volatility window opens, and when to step back. That prevents the constant screen watching that leads to impulsive trades. The first 60 to 19 minutes after the open are where the cleanest ORBs happen. After that, markets tend to balance, volatility fades, and opportunities shift toward mean reversion. Having that time boundary helps you stay efficient and calm. To see how this looks in practice, imagine the Nasdaq futures opening at 9:30 after a strong overnight rally. The first 15-minute candle, that's your opening range. The next candle breaks above it with a surge in volume. It shows aggressive buying. You enter for long with a stop below the range. Partial profits make sense there. You trail the stop beneath the most recent structure, and the rest of the position rides as long as momentum stays intact. Whether that trend continues for another 50 points or fades back does not matter. The trade was defined, structured, and logical. On the flip side, a breakdown works the same way. Price cracks below the opening range low, volume confirms, and sellers drive control. The stop remains just above the high. You're not hoping, you are reading. You're responding to what the market already decided. The reason this strategy endures is that it's rooted in auction market theory. The opening range defines the day's initial balance, and the breakout marks where the market begins to explore outside of fair value. Every trading day starts with that kind of imbalance. The ORB just gives you a mechanical way to participate in it. Mistakes happen when traders treat the ORB like a shortcut. It's not a magic pattern. It's a structure that reflects order flow and it demands context. If the broader market is stuck in a tight multi-day balance, or if it's the Friday before a holiday, ORBs will not behave cleanly. Recognizing when not to trade, it is part of mastering it. Patience is as valuable as precision. The more time you spend observing the open, the more patterns you start to see. You will notice that some days the first move fails and the second one holds. You will see how volume bursts align with news releases or market internals. You will recognize the difference between a breakout led by algorithmic momentum and one that's purely reactive. That kind of observation turns the ORB from a setup into a framework, something that shapes how you read every open going forward. At its core, the opening range breakout is about reading the story the market tells. The market tells right out of the gate. It's not prediction, it's not guessing, it's structure, discipline, and timing. When those three align, futures trading becomes much clearer. The chaos of the open transforms into opportunity. And once you learn to trust the structure, you will realize you don't need a dozen indicators to trade effectively. You just need the ability to listen to what price and volume are already saying.